Amazon is insanely cheap right now. It's $192 per share, and this stock, not even 3 months ago, was worth $242 a share. I'd buy Amazon for $242 a share easily. If you give me that price for Amazon right now, I'm buying it. So why would I not buy it at $192? There's no reason. I think Amazon is an amazing company at a very cheap valuation as it is right now. The expansion opportunities that this company has and the things that they're doing with their cloud computing software, their hosting services, their AWS, the way that the business is growing, even their online space, such as their Amazon stores, their advertising is growing year over year impressively. I think it is second or third biggest advertising agency in the world, only behind Meta and possibly Google. I'm not 100% sure on that, but I know it's up there. And for Amazon to have advertising like that, it's pretty impressive because Meta is a company that is also a great company that you should invest in. Very cheap right now. We can see not even 3 months ago. This company was $736 a share. It is now $575. It dropped more than $150. Over the span of February 14th to March 30th. That's, give or take a month and a half. I don't know, guys. Something's going on in the market right now, and I think that this is a great buying opportunity because I want to take you guys back to a time where something very, very similar happened. Let's look at this 5-year chart. We see a couple drops here and there, right? Well, let's kind of look at a little bit farther back, actually, because we see some drops here and there. We see some drops everywhere. But if we look at what happened right after the presidential election in 2018, we can see that SPY, it fell off a cliff. It went all the way from 290 to 249. This stock, or SPY, the ETF, was up 114% all time. Went down to only up 84% all time. This is 30% drop in SPY like that after the election. And we can see it picked up a little bit, picked up a little bit, and then it's been ripping ever since. The same president just got elected, but something different happened. It rose, and then it dropped. And we can see right here during the past election, something very similar happened. We got the election, it dropped, we can see the drop right here, and then it rose, and it kept rising, and it's still rising. And you can see with these great companies, like SPY included, obviously it's an ETF, but it holds a lot of great companies. There's never been a dip where the stock hasn't gone higher. This would be the first one. If the stock never reached higher than it is right now, it would be the first dip where someone lost money on SPY because they held it forever and it never reached its all-time high. Even the 52-week high is its all-time high, but $613.23. If you buy SPY right now for $554, I can confidently tell you that within your holding period, you're going to have a chance to sell it for more than that. That's just how the market works, obviously, right? But if we look at stocks over here like Amazon, I can also confidently tell you that this one's going to be even more than what it is right now by a wide margin. This is one that people are hating on right now. People are hating on Amazon. They're hating on Meta. You can see what's going on with these stocks. They're getting hated on. And the stocks that aren't getting hated on are Kroger's. Because, what does this stock do? It's going up and up. It's up year to date. Who owns Kroger's? I don't know. If you want to put your money in that, be my guest. But, if we look at, all time, great company. But the past 5 years, up 122%. That's good, but I'd rather be in something like Meta. In the past 5 years, it was up 261%. And that's with this drop. Kroger's didn't drop. It was up 362% before this drop. So, you guys can put your money where you want, but I think that's pretty self-explanatory. And Amazon is the main point of today's video. I think that this one is one that has to be held forever. It dropped 4%. Guys, this is just a company that it doesn't get better than this. Their financials are beautiful. You can't really go that in depth on Robinhood, sadly. But if we just look right here, I like these Morningstar, little analyst things they give right here. I don't think this title's very telling, but I think the price target and the economic moat being wide, that's very true. Uncertainty, medium, maybe, but stewardship, exemplary. I agree. But I mean, yeah, look at this company. They're growing quarter over quarter, and there's just not much information on Robinhood. I'm sorry. But there is a lot of good statistics in this company, like their free cash flow, their profit margin. I mean, this is a competitive company, obviously. But a lot of companies are like that. And Nike, another one that just keeps getting cheaper and cheaper. And Nike came in with horrible earnings. Okay? Let's not sugarcoat it. Look at this. I mean, they beat their very low expectation, but Nike came in with bad earnings. And look at what happened to the stock. Nike came in with bad earnings, and the stock dropped, what, 5%? After there was announced that their sales dropped 17% in China, the stock only drops 5%. I think Nike's reaching a bottom here. Nike's dropped a lot. 32% in the past year. It's down 24% in the past 5 years. And during this time, you were up 111% and went all the way down. I mean, all time, another great company. But Nike is just not the stock you'd expect to do that. And I'm not buying Nike because I love Nike clothes or because I love Nike shoes. It's because, I mean, I do. But this stock is too cheap. Like, there's so many stocks in the market right now that are way too cheap. You can see right here, I got almost a $6 dividend right here. And I'm not even, I mean, I'm sure there's many people watching this video that have a lot more money than me. But, I mean, you see right here, I only have $1,570 in Nike. I want to grow that, obviously. But I'm getting $6 dividends from only that. So, I mean, you can see how high your dividends can go. And we can see the fair value here is $112. That's what they think right now. Nike, in this position, they think the fair value for Nike is $112, and it's half of that. This is a 100% gainer right here. I'm telling you, one day, this is easily 100% gain stock. Please get in right now while you can, because it's not going to be like this forever. And as soon as market opens on Monday, I'm going to deposit some money and buy some more Nike, and I'll show you guys that too. But these stocks are getting way too cheap to ignore. Nike, Amazon, Meta, AMD. This is just too cheap. These stocks should not be priced at these values. We have the fair value right here. It's 140. And I mean, are these optimistic? I don't even think so. And AMD has all of these money-making facets, and they own growing businesses in like ZT Systems. Like, there's so many catalysts for this company, and it's so cheap right now that the risk to reward is insane. Another stock that's very cheap that I own a good amount of, Elf. Guys, the stock is dropping off fear of tariffs 50% in the past 3 months. This business has been through this before. There's been a presidency of the same president before where tariffs were threatened. And tariffs were talked about, and it was all blue under the water. And this stock is just one that's been very, very well priced, $210, and now it's 64. And that's not going to be the all-time high for this stock. This stock's going to be worth more than $210. They have the biggest market share in the makeup industry. Elf Beauty, go check it out. And they're a very young company. It's a company that started in 2016. So I think we're going to be looking back, 10 or 20 years from now. And I think that this company is going to be one like if we look at this right now, 2016, okay, they're $24. Let's check Estee Lauder. It's a company that's also going through a pretty big correction, but we can see right here, they started in 2000, they were $21, and for a while here, they were in the 370s. But this company is definitely going through a huge correction, but I mean, you can see the potential of getting in a company young. I mean, they were at 21, and then you go all the way up there. And then Elf is just like that. This company is very young. It's 2017. It's been out for not even 10 years. It hasn't been a publicly traded, or 2016. It hasn't been a publicly traded company for 10 years yet. This company is one of the youngest brands. It's very fast growing, and it's insanely cheap. I can't emphasize it enough how cheap this company is. And there's no analyst rating for this one because it's not very widely covered. That's why you guys need to get into it before it is. I don't know, guys. This is a company that its PE ratio is so low in comparison to its profit margins and what it's doing. The stores it's in, it's the quickest mover in Target. They're going to be inside Dollar Generals all across the country. There's so many things that this company has going for them that you need to get in on now before it's too late. because we've seen this company, it moves on news like crazy. We could see right here. I mean, it doesn't look like a big new move because of how much it dropped, but down 48%. It went 7% in about a day or two. I mean, this company moves fast. This company, you got to get on the boat right now, or it's gonna leave without you. That's what I'm saying. So yeah, I mean, a lot of great companies in my portfolio. I think very very cheap companies. That's the strategy. Buy great companies when they're cheap. It's worked out for me so far. I don't think it's gonna stop. But I appreciate you guys for watching. I hope you enjoyed this video. I hope you gained some knowledge. I hope you guys can do this. I'll catch you in the next one. Be sure to like this video, subscribe, and also comment down below if you enjoy this content. I'll catch you. Thank you for watching. Peace.